So we have now discussed what is the working capital finance, the fund-based working capital finance. Now we will talk on the non-fund-based working capital finance. Banks extend various facilities by way of non-fund-based working capital, various non-fund-based limits without the flow of funds. As I told you in the beginning itself, this non-fund-based is a special feature of non-fund-based facilities, that is no fund outflow. And what are the facilities that are being considered by the banks to the customers? They are, under this non-fund-based category, they are bank guarantees, then letter of credit and co-acceptances. These are the three types of facilities under non-fund-based category being provided to the customers. Now let us look on the slide. There is a bank guarantee, then letter of credit, then co-acceptances. Then let us discuss, let us talk on each item one by one. What do you mean by bank guarantee? You must be familiar with the bank guarantee. Bank guarantee is defined under the Indian Contract Act, section 126, is a contract of guarantee, contract to perform a promise or to fulfill an obligation of a third person in case of default. Here, it is a trilateral agreement. Trilateral, because in a guarantee means it's a trilateral one. Three parties are involved. There is a principal debtor, the creditor, and the surety. Who is the principal debtor? The principal debtor is the person on whose behalf, or the customer on whose behalf the bank has considered this facility. And who is the creditor? Is the beneficiary of the guarantee. And who is the surety? The party who issues the guarantee. That is no one other than bank. So and bank normally issues these guarantees for contractors and other business people. And the guarantees are also of different types. Bank issues guarantees of various types. Which are they? That is, they are one, performance guarantee, then other one is a financial guarantee, and the third one is deferred payment guarantee. Let us have a look on it. What is this one? Performance guarantee. Just we will touch it. These three type of guarantees: performance guarantee, financial guarantee, and deferred payment guarantee. And what is performance guarantee? Performance guarantees are, it is a transaction related contingency. PGs are, the performance guarantees are essentially transaction related contingencies that involve an irrevocable undertaking to pay a third party in the event of the counterparty fails to fulfill or perform a contractual non-financial obligation. Here the difference is that in a performance guarantee, the main difference is that it is for a contractual non-financial obligation. Under this guarantee, the risk of loss is primarily related to the event. In the event of the non-performance, it is related to the event rather than on the credit worthiness of the borrower. Banks issue these guarantees in favor of the contractors for towards bid bonds, margin, towards earnest money, etc. Then financial guarantees are nothing but it is a credit substitute. Here, if the bank irrevocably undertake, PGs are direct credit substitute, and wherein the bank irrevocably undertake to guarantee the repayment of a contractual financial obligation. It carries the same risk as that of the extension of a credit. Here, the risk of loss here also lies on the creditworthiness of the customer rather than on the happening of the event, as in the case of performance guarantee. Okay. Then what is a deferred payment guarantee? It's a third type. It is as good as a term loan, because deferred payment guarantee, in case the seller prepares to sell the plant and machinery to the buyer, that is our customer, on deferred payment terms, and provided he submits a bank guarantee. In case of default, somebody has to give the money, So bank guarantee, it is supported by a bank guarantee. Here the responsibility, the obligation on the bank will arise only when he defaults in payment of the installments. The deferred payment guarantee name itself deferred. It may be for capital investments, capital import, capital procurement of capital goods. So the period, quantity, the value may be substantial. So the period of payment may be spanned for a number of years. The installments are also fixed periodically, say quarterly, half yearly or yearly. And on the due date, the customer is required to make good this amount of the installment, and in case of default, the bank is required to honor the commitments under the or to pay the installments on due date. The responsibility lies only when the due date or only when the installments fall due. In all practical purpose, it is a non-fund-based facility, but even in the banks also take it as a even delegation purpose and other, it is a financial one. It is because delegation also it is treated as financial one, accordingly delegation authority is fixed. Now comes some examples, that is PGs. What are the examples? Bid bonds, guarantee bonds in earnest money deposit, then guarantee on behalf of the contractors, performance bonds and export performance guarantees, EPC guarantees, export packing credit guarantees, EPC contract, then guarantees for mobilization of advance, retention money guarantee. These are all different type of purposes for which the performance guarantees are being issued. Now the financial guarantees, that is guarantees towards disputed liabilities or revenue dues, sale tax, income tax or disputed liabilities, court, etc. Then guarantees favoring bank, financial institution and chit funds. So you suppose the guarantee is issued in favor of another bank for giving some facility to one of your customers because you are not in a position to provide. Such guarantees are also known as financial guarantees. Then deferred payment, this deferred payment what I said, that is also coming under the broad category of financial guarantee. Now comes how this guarantee limit is being assessed. So guarantee limit, this mainly depends on four category, mainly depends on what is the nature of the activity of the unit. Then second one is the purpose of the guarantee is required, purpose of the guarantee. Third one is the purpose, then the duration of the guarantees. Then the type of guarantee is required. These are the four categories, four items which are being properly examined by the banker at the time of granting the limit, bank guarantee limit. Here how it can be assessed? Yes, while discussing the customer is providing you, or customer is providing the financial data and the discussion everything is done and you are accepted, and the bank has taken a decision to finance the customer. The fund base already assessed. We have seen the various type of guarantees that is performance, financial and deferred payment guarantees. Now let us talk about how these limits can be assessed. Yes, the first and primary things to be seen, to be examined by a banker is what is the activity of the customer. Then what type of guarantees, means what is the purpose of the guarantee. Then what type of guarantee is required and what is the duration. These are the four factors which are being examined while assessing the guarantee limit. So for assessment purpose, yes, assessment purpose, normally they will discuss with the borrower, discuss with the customer, what type of, they will discuss with the customers and they will jot down the requirements. Say for example, if the customer says that our electricity is consuming it's a power incentive unit, so consuming more electricity, and due to their good track record, the state electricity board has permitted for the deposit they can provide a guarantee. Even for consumption of the electricity monthly, this one they can give a guarantee. So he says that the electricity board has permitted us to provide a guarantee so that the blockage of funds can be eliminated. He can utilize these funds which are being provided as a deposit. So electricity, yes. Then monthly consumption, yes. Guarantee, yes. Then he says that state electricity board has permitted, yes, they are ready to accept bank guarantee towards the deposit. as also this monthly consumption of the power. Then he put forward another request, yes, I am procuring raw material also. So raw material is also available partially against these bank guarantees. Yes, bank guarantee requirement. You have to, means as a banker, we have to satisfy. Then he says that yes, during the year, we are participating in various tenders. Okay, because our nature of this one, we participate in the tenders floated by the government institutions, government bodies, and we participate, and for which we are required to give bank guarantee towards bid bond, then margin money, etc. So in that case, my requirement is say a particular amount he is telling. Yes, in that case, the banker will also examine what was the past trend, what is the success rate in the previous year also, in the previous 2-3 years they can analyze what is the what are the number of tenders he has participated, what is the success rate, and based on that a decision can be taken. Yes, this much can be considered. Then again he is telling, during the year I am going to import a particular machinery, which is because that after installing this one I have to, as per the government guidelines, I have to produce and export it. By doing so, I am eligible for the duty exemption. For getting this duty exemption, this is known as countervailing duty, he is required to give a guarantee for the performance of the export once the machinery is installed. Then similarly, he is having some dispute with the sale tax, income tax and like that. For that also they have permitted. Yes, that dues can be, instead of making the deposit of the dues, the matter is before the court and court has permitted, yes, instead of depositing in cash or by bank a fixed deposit, he can give a bank guarantee. So these are the various purposes he is discussing, and he is coming to the conclusion, yes, these are the requirements under various heads. That is identification, that's first is noted down, then identify which type of facility, whether it is performance guarantee, whether it is a financial guarantee or it is a deferred payment guarantee. Then nature of the activity, everything, VG, then yes, with after discussing all these things, you will be coming to the conclusion, yes, these are the requirements under various heads, and you can identify, you can segregate it, which type of guarantees are required. Is it a performance guarantee, financial guarantees or deferred payment guarantee? And once that exercise is over, then it can be properly put here and assessment can be done. See, at the time of this particular day or particular month, you can work out what is the outstanding VGs. It's an existing customer, so what would be the outstanding VG as on the date? That is taken. Add during the year the guarantees which have been issued in the past. A few guarantees may likely to be cancelled during the year. So what is what are the number and the amount of guarantees which are likely to be cancelled during the year? You deduct that one, you will get outstanding less guarantees which are going to be cancelled. Then requirement incidental to the regular operations, because what we discussed here, based on that, what is the total requirement of guarantees, that can be put here. Sorry. Here, first is outstanding VGs, then cancellation envisaged, how much guarantees are going to be cancelled, requirement incidental to the operations, requirement pertaining to the contingency, some 5% or 10% additional limit can be considered, and based on that, this banker can ascertain what is the total guarantee requirement. That is A minus B, that is outstanding minus cancellation, plus C and D, the total this one. They can draw another column also. If it is performance, then financial also they can put, deferred also they can put, accordingly the total limits can be worked out. Now this is about guarantees, okay. Now what even by letter of credit? Now second facility, these guarantees we have seen, 3 guarantees, how it is being assessed. Then letter of credit, see, any seller, ideally any seller would like to receive the payment before he parts with goods or services. Similarly, the buyer is also would like to have the goods as per the specification and within the time frame before he parts with the payment. So if the seller and the buyer both are located at two different distant places, these conditions cannot be fulfilled. There the requirement of an intermediary emerges. Who is the intermediary? It is nothing other than the bank. The bank issues a letter of authority in favor of the seller. Yes, if you submit the documents strictly as per the order, or as per the purchase order, or as per the list, as per the documents listed in the assurance letter, then this assurance letter itself is a letter of credit. If the documents listed in the letter of credit is submitted, bank will honor the payment. If the terms of the payment is against payment, means the document, after verification of the documents, bank will make the payment. If any credit is given, in that case, bank will get this document accepted by the buyer and honor the documents on the due date. This is known as the letter of credit. Letter of credit is a very popular form of facility, a form of this letter of credit. Letter of credit is a very popular form of non-fund based facilities that are being provided by the banker to the customers. There are various type of letter of credit. That is, it may be document against payment. As I said, the documents once were issued, bank is required to make the payment. Then credit is given, that is DA, the document against acceptance. Then letter of credit, it may be an inland letter of credit, it may be a foreign letter of credit, then revolving letter of credit, back-to-back letter of credit, then transferable letter of credit, then red close letter of credit, then green close letter of credit, then omnibus letter of credit. That's various type of letter of credits are there. But time is not there to explain all the things. Now let us go to actually the letter of credit is another popular non-fund facility extended by the banks. It is an undertaking given by the banker to the supplier, confirming that the bills will be duly paid by the bank either on the presentation or on the expiry of the stipulated period, subject to the terms and conditions mentioned in the letter of credit. LC issued by the bank is generally irrevocable and shall not be cancelled without the consent of the buyer. Now, our purpose here is, we have seen that what is letter of credit, then how this limit can be assessed. It is a method of payment of trade credit. See, now we have seen that what are the different type of LCs. Then how this LC facility, how the LC limit can be assessed. What are the factors to be looked into while carrying out this exercise of assessment of the LC facility. See, first and foremost one is whether the LC is on DP terms or DA basis. DP means document against payment, that is, there is no credit is involved, and whether it is on document against acceptances. Then the periodicity supply of the seller, then credit, what is the credit period available, and suppose even after the LC is established, it may require some time to reach there and shipment will take place. That is known as a lead time, the time required from establishment of the LC to the time to the shipment of the goods. That is known as a lead time. Then another factor is to be seen whether in many cases, suppose import is involved, okay. So foreign supplier may insist that I cannot supply in piecemeal. I wanted some but minimum quantity to be supplied. That is known as economic order quantity, EOQ. When such EOQs are involved, EOQs are insisted, EOQs are there, then assessment will be slightly different. Okay. Now minimum size of each consignment, that is what EOQ says. Then whether it is freight, what is the freight in cost involved, what is insurance, then all these LC everything that is strictly complied with the guidelines of FIDE, then FEMA, then UCPDC. No LC for capital goods capital goods without the template facility should be considered.